If you're a Canadian investor, there's a high likelihood you're looking for fantastic dividends. And if you're looking for fantastic dividends, then there's almost nothing better than a passive indexed ETF. Well, I think I found probably the best option available right now in Canada. Today, I'm going to talk to you about why I think this clears the rest of the competition, why I think it's such a unique opportunity, and why I think you should check it out if you're interested in dividends or even just to put into your portfolio if dividends are something you're thinking about in the long term. Welcome to Golden Rich Investing. My name is Liam. Here we talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. I've got an article on the screen right beside me from Seeking Alpha, and it does a really good job of explaining why this ETF, XEI, is such an interesting opportunity, specifically for Canadian dividend investors who do want exposure to long-term results. And that fits exactly what we try to do here on the channel, where we talk about dividend growers, we talk about fantastic dividend opportunities, but we don't miss out on growth. One of the biggest things that people who don't like to invest in dividends can use against us as dividend investors is, hey, you're missing out on all this capital growth. They can point to charts with historical returns saying if you just invested in the index, you would outcompete, let's say, blue chips or dividend payers, dividend kings, whatever category of dividend stocks. However, the specific strategy of this ETF, I think, is a complete opposite of that argument. I think these guys actually are picking really smart long-term growth companies that just happen to pay great dividends. And because it's in Canada, we have exposure to some of the very best of those kinds of companies. Let me take you through this article. I'll give my own commentary, of course, on top, but I think there's some really interesting points. As always, if you do pay for Seeking Alpha, you've accessed this to yourself, please do check them out, Trapping Value. So to summarize, this is a passive ETF. It tracks the Composite High Dividend Index on the TSX. Primarily uses a replication strategy, so they're basically exactly replicating the index. Top 10 holdings account for nearly half the portfolio, thanks to the size of some of the biggest companies, of course. You're thinking big banks. And with a 0.22 expense ratio and a yield of 4.6, they provide monthly distributions, which is awesome if you do want to use those dividends in the not so distant future. Way easier to live off a monthly paycheck than it would be to try to live off a quarterly or yearly one. So the fund, this iShares S&P TSX Composite High Dividend Index ETF, which is of course going by ticker symbol XEI, is a passive fund, primarily invests in Canadian equities. Its aim is to provide long-term capital growth, which again is something that I love. Completely combats that argument that dividend investors miss out in the long run. As the author notes, it chooses its portfolio constituents based on their dividend yield, and usually we have funds with yield as the primary goal and capital appreciation as secondary, since it's hard to achieve the latter via high yielders. But XEI does a good job of threading that needle. It's passive in nature. It endeavors to replicate the performance of the index. In this case, it's the Composite High Dividend Index, which has the option to use either replication or sampling strategy. The fund mainly uses the former, so it's replicating exactly. Now, some people argue that that strategy presents a little bit more risk because, of course, you have more concentration in bigger names. Think an RBC, one of the biggest, no longer number one, but one of the biggest companies in Canada. Of course, if you're replicating the index, it's going to have a much higher weighting than if you were simply sampling from the index. But in my personal opinion, that also gives you exposure to higher quality companies that are likely to grow faster. And it forces the index, forces the ETF to cut underperforming names. Think about a BCE over the last couple of years. If you were simply sampling and you were looking for the yield, you might have increased your holdings of BCE. But if you were going by the index and you were completely passive in nature, you avoid that pitfall. You avoided buying the dip, and instead you put that money into things that seemed expensive, like an RBC, but have performed well. It's kind of the beauty of passive investing is that, well, it defies logic sometimes. Bigger names often do outperform small caps. Just simply how it goes. It was fun formed in 2011, is close to 2.1 billion in net assets. In terms of sector concentration, financials, of course, hold the top spot, followed closely by a personal favorite, the energy sector. Utilities comprise close to 15%, communications almost 11, and of course, the next 15 is split up. You can see right here on the screen exactly what that means. So financials and energy at about 30, utilities at that 15, communications about 10. Then you got materials, real estate, discretionary, industrials, healthcare, staples, and then cash and information technology. Information is smaller than cash. I guess it goes to show you don't have a lot of high yielding information technology stocks, eh? Top 10 holdings are made up of well-known names. So you got Toronto Dominion, Royal Bank, Enbridge, Suncor, TC, Canadian Natural. You got Nutrien in there, Bank of Montreal, Fortis, TELUS. Basically all names that most Canadian investors will know. Some will have positive opinions, some might have negative. I think most of the names on here I'm pretty positive on. I'm not a huge fan of every single name, of course, but again, that's part of the beauty of passive investing. If you really do want to spend the time and try to beat this index, you can go for it. But wouldn't it be easier to invest in the whole and just allow time and compounding to do its thing? Author mentions they've covered a lot of these different stocks. You see the performance and the yield here. You got some that are very, very high yielders. I think that's TELUS in the sort of darker orange color way up at the top. But everybody else is more or less in the 3 to 6 range, let's say. And that's, not unreasonable actually in Canada. And it is above what you might consider normal in, let's say, a US dividend ETF. Let's say an SCHD, for example, a very, very popular US dividend ETF. But in Canada, a lot of these yields are actually pretty normal for stocks like this. We actually have lots of stocks that we've talked about on the channel that beat some of these yields. But again, the point isn't just yield here. It's also the long-term growth. And we've got some fantastic long-term compounders on here. Specifically, the big banks absolutely are fantastic long-term compounding stocks. They talk about the management fee and expense ratio, which really isn't that high. The management fee makes up almost the entire expense ratio, which is awesome. You got a monthly distribution. So you see every single month, it's a regular distribution. It's constantly growing over time there. You can tell the numbers above. This is not a managed distribution policy. Numbers go up and down based on what's happening. But if you looked at it over the long run, of course, it's going to be growing and growing. Expenses are normal and it yields 4.6%. In terms of total returns, let's bring the goals of capital appreciation into focus. Fund is kept up with its benchmark. Wouldn't make too much of the 5-year return as it was after a gut-wrenching bear market post 2020 there. Of course, we've talked about that lots. The total return over 5 years on almost anything right now is like, whoa, we're making hundreds of percent. Don't expect that all the time. Of course, anytime you're buying in a crash or a bear market, you're going to have better or outsized returns coming out of that. Index does not have any expenses. The fund, of course, does have a few. So what is their outlook? Performance is very decent. They're wary of gouging the merits of a fund without looking at how it did in a bear market. To that end, XEI held up quite well. Ended 2022 flat, which is impressive considering what the market was like. It was a brutal time. Kudos to the index choice. One good comparative for this fund is the iShares S&P TSX capped composite ETF, XIC. It's a large cap passive ETF that does not weigh dividend yield into its metrics. But think about the Canadian market. Even if you're not trying to weigh dividend yield, you're probably making a good dividend yield anyways because of how closely tied so many of Canada's dividend payers are to our largest companies. Again, part of the reason why it's so awesome to be a dividend investor here in Canada, because unlike the US where you're looking at of the big tech, is Google the best dividend stock right now? Instead, you're looking at fantastic options. You got a plethora of choices. There's a big overlap, of course, in top holdings between them. XIC holds some stocks like Shopify, Brookfield, and Constellation, none of which we dislike on the channel, all of which we like as stocks, but have basically the same returns. And if you look at that, right, we're 5% off, right? With the XIC doing 5% better, particularly in the last couple of days. Think about that. Shopify 20% bump probably helped out. Present market valuations, we prefer an extremely defensive approach, and to that end would choose XEI over XIC. Obviously not a popular opinion, as the latter is 9 times the assets. That said, we still prefer a non-passive mode of investing and think the alpha one can add via this approach alongside covered calls is higher than any other time in recent history. Now, obviously, any of us here who talk about stocks on the internet, this is part of what we do. We are passionate about this. We're going to prefer active investing. However, that does not mean active investing is right for everybody. And this is kind of contrary to what benefits people like me who talk about this on here. But most of us actually in a TFSA, something where you have a limited amount of contribution, probably would benefit from having most of our portfolio passive. And actually, I do this personally. If you ever check out the Larch Fund, I've got a series here on YouTube. I talk about it on Blossom quite often. I post on Blossom about it. And of course, it is available for you to see at any time exactly what I hold in there. If you check that portfolio out, it is about 40% the S&P 500 right now, a passive approach. And I think as time goes on, I would really love to have something that looks just like this in that portfolio, because having a great high dividend yield, but growth oriented ETF in there that is passively managed, that follows the Canadian market, really would be fantastic for me. And as time goes on, as I get into life and times get busy, etc., I imagine instead of trying to pick my favorite Canadian dividend yielders, I'll probably go more and more into owning XEI. And I genuinely think for most people, this is probably the best Canadian dividend ETF you can pick out there. It gives you exposure to long-term growth, gives you exposure to fantastic quality companies and the yield right away. We're not talking yield on cost. We're not talking down the line. We're not talking over 5-10 years. The yield today is almost 5%, which is, again, fantastic. And with a diversified ETF that is passive, that you don't have to stress about, you could be making hundreds of dollars off of a very, very modest investment. And over time, you let that thing grow. You let your yield on costs grow. You could be talking double-digit percentage gains. And on top of that, having a fantastic double-digit yield based on cost, I mean, the opportunity here is fantastic. It is amazing. These are some of the best stocks that you can hold in Canada right now. And I think if you're looking for a dividend, there's almost no better choice. So check it out and let me know what your thoughts are in the comments down below. Do you like this ETF? Is there one you prefer? And if so, why? I'd love to hear your thoughts. If you made it this far in the video, you like what we do here on the channel, please do like the video, subscribe to the channel. And as always, I hope I see you in our next video.